In 2010, money felt easier again. Not abundant, not exciting, but stable. The panic had faded, the headlines had softened, and for the first time since the financial crisis, the world stopped holding its breath. Markets were rising, jobs were slowly returning, interest rates were near zero. It felt like the storm had passed. But beneath the surface, something fundamental had changed. The rules of money were no longer the same, even though most people behaved as if they were. 2010 was not the recovery people believed it to be. It was the beginning of a quieter, more dangerous financial era, one built on suppression, incentives, and invisible trade-offs. And almost no one noticed. By 2010, the trauma of 2008 was still fresh. Banks had failed, housing markets had collapsed, trust in financial institutions was damaged, but not destroyed. The worst outcomes never arrived. ATMs still worked. Governments intervened. Markets survived. So a comforting belief took hold that the system had been fixed. The crisis was seen as an exception, not a signal, a failure of excess, not of structure. Low interest rates were viewed as temporary medicine. Stimulus was framed as a bridge back to normal. Central banks were trusted to step aside once stability returned. For most people, money still worked the way it always had. Work steadily, save responsibly, avoid unnecessary risk. Time would take care of the rest. But 2010 didn't restore the old system. It quietly replaced it. Interest rates did not rise. They stayed near zero. Quantitative easing did not unwind. It expanded. Debt did not disappear. It shifted from banks to governments, from private balance sheets to public ones. Markets rose, not because growth was strong, but because money was cheap. Asset prices recovered faster than wages. Stocks rebounded years before incomes did. Housing stabilized, then slowly detached from affordability. The economy healed unevenly. Risk was not removed. It was disguised. And behavior adjusted, slowly and silently. Saving stopped feeling rewarding. Cash returns collapsed. Caution became expensive. People were not reckless. They were cornered. To preserve purchasing power, they had to accept more risk. To grow wealth, they had to enter markets they no longer fully trusted. 2010 taught people that money was no longer neutral. It was managed. Those who already owned assets benefited first. Stockholders saw portfolios recover. Property owners regained equity. Institutions with access to cheap credit refinanced and expanded. They didn't need optimism. They needed access. But for those without assets, the experience was very different. Wages recovered slowly. Savings earned almost nothing. Opportunity felt increasingly distant. The divide did not explode overnight. It widened quietly. The recovery looked calm enough to avoid scrutiny, yet unequal enough to reshape long-term outcomes. Those who adapted early accepted a difficult truth. Waiting had become a risk. Those who remained cautious followed old advice in a new system and paid for it over time. The first lesson was structural. Markets no longer reflected economic health. Asset prices could rise without productivity. Growth could exist without broad income gains. Stability could be maintained without resolution. The second lesson was psychological. Low returns did not feel dangerous. but they were. They encouraged delay. They punished patience. They quietly eroded purchasing power. And the final lesson was permanent. Once emergency policy becomes standard policy, behavior changes forever. 2010 was not an exception. It was the beginning of a financial environment defined by intervention rather than cycles. Many people never adjusted their expectations, and that mismatch slowly shaped outcomes for the next decade. Today's investors live inside the world that 2010 created. High asset valuations, persistent debt, markets shaped as much by policy as by fundamentals. The mistake is not participating. The mistake is assuming the system behaves like it once did. Modern investing rewards understanding structure over stories, liquidity over narratives, time over timing. Patience still matters, but it must be intentional. Because money no longer waits for fairness. It moves toward incentives. In 2010, money felt easier because danger became quieter. The fear disappeared. The distortions remained. That year taught a subtle but critical lesson. Financial stability can exist without financial health. Recognizing that is not pessimism. It is clarity. And clarity is what allows long-term wealth to grow, not by chasing recovery, but by understanding when the world has already changed.